Hello, everybody. This is Piyush Jain, and you're watching Nirmal. Now, economy is a very important subject. We have seen what has been happening over the last couple of weeks around the globe for the Indian economy. There have been a couple of unfortunate instances for the some of the U.S. banks going under. We have been seeing over the last couple of months inflation touching the roof. It has been a commodity-led inflation. In India, also inflation has gone up. There has been interest rate hikes across the banks. We are seeing RBI follow the same course. Again, US Fed has raised the interest rates. We also saw ECB, the European Central Bank, that actually had raised interest rates a couple of days back. So now the question here is where we are right now, what is the data speaking, and are we expecting some more rate hikes? So I think let's start with that theme, and then I think we'll start sort of talking about more economy here. But to discuss all of that, let's welcome our expert today, Mr. Indranil Pan, Chief Economist of Yes Bank. Sir, welcome to the show.
Thank you.
So, sir, let's straight away start. What should we make out of the US Fed raising interest rates and what it implies for us? Because on one side, we are saying there are some systemic issues where some banks are really facing some issues due to sort of bonds and sort of mismatch of risk. And on the other side, inflation remains very high for the US, so interest rates are going up. For us in India, where are we and how do you see the situation?
Starting on the US, I think they are caught in a bind in the sense that on one side inflation remains high, but they are seeing some amount of financial instability creeping in. And I think the way the Fed Chair Powell tried to explain this is that keeping in mind the high inflation and the very fact that no economy does well when inflation is on the higher side, they will probably have to raise rates. Immediately, most of the actions that have been taken to cool the nerves in the financial sector in light of the SBV collapse, I think they are confident, more or less, or appearing to be confident that there is no systemic shock that is there in the economy, and hence the Federal Reserve continues to look at the inflation as one of the most important metric to raise rates. The other thing, what Powell is also pointing out, that there can be some credit tightening, which also will lead to some amount of tightness in terms of the monetary policy. And therefore, the rate hikes that we were talking about, the extent of the rate hikes may actually be shorter. So there is a clear sort of direction in the sense that rates will need to go higher, but to a certain extent, there is some dovishness that is coming on in the trajectory that the Fed is building out, and possibly the trajectory today is slightly lower than what it was even say 15 days back. Coming down to the domestic conditions, I think this is definitely a big input for the Reserve Bank of India. But having said that, let us not also forget that the last two readings for domestic inflation has also been higher than 6%, which is the threshold level. And the RBI needs to continue to show resolve to bring inflation down. The worry appears to be the core inflation, which necessarily means that we would look forward to another 25 basis points increase in the April meeting. Probably even in the April meeting, they will probably not be able to change the stance before we are confident about the trajectory of the inflation in the days and the months ahead.
Right, and that's another interesting sort of point here. But from here, when we take a look at the economic data, I was just looking at the recent sort of economic data which came out, the fortnightly data here, and I'm talking about a couple of metrics, but we actually will go one by one here. Bank credit growth looking still solid, 15 to 16% credit growth, getting maintained across many months. Electricity generation that remains very robust. Rail passenger traffic, freight traffic, air traffic, all remains at high levels. There is no evident sort of sign of slowdown here. Um, what should we make out of the credit growth here? Is the demand very solid? Like how's it looking to you?
The credit growth possibly has a lot of sides to the story. One is, let us also understand that the market is to a certain extent substituting ECB for domestic credit, because the external commercial borrowing has also been at a relatively much higher rate. If I really compare the external commercial borrowing to the domestic borrowing rates, it possibly doesn't make sense today to borrow externally given the huge uncertainties that you even face in terms of the currency. And unless there is a pause in the rate hike cycle globally, and we understand what is the differential in the interest rates from raising an ECB abroad to borrowing domestically, we might continue to see credit growth being or relatively on the stronger side because of the absence of the ECB. The second factor, of course, is that to a certain extent, there are some year end adjustments that generally tend to happen, which is seasonal. And we will continue to expect that to happen even in this March. And hence, a credit growth of a 15 to 17% doesn't seem really to be out of track given these two factors that I just pointed out. Going forward in FY24, we are expecting credit growth to taper off to about at 11 to 12%. One, because we are expecting general inflation levels to be on the lower side, which necessarily means raw material costs, and therefore the managing inventory cycles without needing too much of working capital. That will be one factor which will bring interest rates down. Second, we will have a much better clarity in terms of growth, in terms of the external atmosphere, in terms of where global interests are, and that to a large extent also will have its implication for the credit demand domestically.
Right. And if you do, are you expecting a sort of a strong interest rate cuts some quarters down the line by RBI?
It's a very loaded question, but it's a very difficult question. I think even if you sort of very carefully read Powell's statement, there are signs of sort of absolute raising the arms in the air and wishing that everything gets better from tomorrow and inflation comes down. So I think it's a very mixed bag over here. Personally, I do not feel that India suffers the same type of financial instability that some of the European countries, some of the European banks, and the U.S. Financial system is facing at this point in time. That's a pretty important point to note from the domestic perspective. Secondly, inflation even in India is on the higher side. But given the fact that we do not see any sustained sort of or any risk or to the financial system immediately in the domestic economy, I think the RBI will possibly be able to hold on to the rates for a relatively longer time, and they can only cut only if growth slows down very significantly, which is also not sort of likely, as you pointed out in all the data that you mentioned. And also the very fact that given those data on the services side that you mentioned, the core inflation could continue to remain sticky on the higher side. So all these factors have to be taken into consideration before we talk of any rate cuts at this moment. The best we can talk of at this point in time is the phase where they will pause and then understand the risks that play out beyond that over the next few months.
Right, sir. From that perspective, what is the sort of sense you are getting from robust freight traffic and toll collections both? Because we were just sort of thinking around that the rail freight traffic, the data I was looking at, almost the March data again is almost at the same levels like the last 6 7 months. Is that indicating that commercial activity is moving quite smoothly within the domestic market?
So I think there are sort of again once again we are expecting a slowdown to happen, but
Okay.
the domestic consumption demand still appears strong, and the problem that I think we see at this point in time is that the previous monetary policy increases have yet not hit the consumption demand in a very significant way, and possibly we are still in that phase of unwinding of the significant amount of savings that we had during the COVID times. So all that taken together, I think to a large extent, it will be a relatively steadier ship from an Indian economy point of view, even if the external atmosphere is a sort of the risk is strong in the rest of the world of a significant amount of slowdown.
Sir, if the slowdown happens, what is the sort of divergence is going to happen between rural economy and the urban economy?
I think the rural economy, to a certain extent, we are seeing some amount of pickup in the rural wages. Now, the other thing that we need to realize that the MNREGA budget has been reduced, which means that there is an expectation that the rural economy will be relatively stable from here on. But the critical issue to understand here is what happens to the southwest monsoon. There are certain indications of an El Nino, which necessarily means that the monsoons could be weaker. We have had some unseasonal rains, and there are some reports coming out of damage to the standing crops. So that is also sort of likely to be taken into consideration. Now, there are two aspects to the rural demand. One is if everything of this leads to a lower output, whether there is a very sharp jump in the prices of the agricultural commodities, that may actually negatively affect the rural consumption than the higher prices positively affecting rural consumption. Simply because
Absolutely.
in India, we have a significant amount of farmers who are subsistence farmers, and therefore they need to buy a lot of agricultural produce even themselves, even when they are farmers. So, given this consideration, I think the perspective of a weaker monsoon will be much more significant on inflation than on the growth perspective, and then we can expect rural demand not to pick up in the same way that we had otherwise been expecting.
Right. And from that perspective, sir, right now, how's the sort of the non-banking financial space looking to you? Like there are banks again, like between the two, if there is any slowdown happening, interest rates are going up. How's the sort of NBFC sector looking to you?
I really don't sort of know about the NBFC sector much. I've not really seen the recent data, but most of the hearsay that I have is that I don't think there is any problem in terms of the microfinance institutions. The collection and the payments are on track. If I look at the financial stability report of the RBI, the last financial stability report that came out in December, I don't think there are any risks that have been raised on the NBFC sector at this point in time. Again, coming back, I think even whatever is happening in the global atmosphere, I don't think the financial system in India really stands a big risk because the exposure to some of the bank names that we hear from the external side are not really sort of we don't have very significant exposures in those areas.
Right, and coming back to the commodity crops, again, this is a Rabi season, so we generally talk about the wheat crops, some jeera, chana, largely again where we talk about the northern and the central belt. From that aspect, keeping in mind the recent sort of uneven rains, whatever happened, but before 15th March or 20th March, half of the crop was harvested. So, from that aspect, have you sort of observed or heard or seen anything where we really need to sort of worry about any possible spike in the prices of these commodities or any chances of crop loss?
At this point in time, I think, given the fact that the government has also released a significant amount of wheats in the market, we don't see a chance of an upsurge in the prices immediately. However, having said that, in terms of the prices, it is not only the domestic crop but also the global supplies that tend to affect because India is one of the key sort of suppliers of the global food, and we all know that we had some time back in the last year we had stopped the exports of wheat and rice. So it's a very difficult question to answer. If there is a general global warming and if global supplies also tend to be relatively on the lower side, then irrespective of whatever is happening in the domestic conditions, we can still see an increase in the prices. I very clearly haven't really been checking the procurement data, but whatever I have been reading, I think to a certain extent procurement may be lacking at this point in time, even though, as you mentioned, the harvesting has been strong. So it's again a very difficult question to answer in terms of how the prices move in terms of the agricultural commodities.
Okay, sir. And let's also talk about the sort of debt market. We of late actually have been seeing that in equities over the last 6 months, on an average, we have been seeing outflows from FIs, FPIs. Largely, there has been selling from them, and our domestic investors basically have been continuously buying. Like, I don't remember, basically almost since September there has not been a sort of a negative month from the domestic investors. On the other side, on the debt side, we basically have seen some outflows. So, what is your reading into the systemic liquidity right now? At what RBI is managing right now, and also how's the debt market looking to you?
So you did talk about the liquidity perspective only from the equity and the debt market. I think the liquidity perspective also comes from, as we were talking some time back, in terms of the lower ECB flows. The
Absolutely.
FDI flows also appear to be relatively weaker in this year at this point in time. Till the point in time we have the data compared to the previous year, which is also a liquidity negative. Now, in terms of the global markets, I think the risk aversion is likely to play out quite significantly going forward. And given the banking sector uncertainties, given the slowdown uncertainties, we might see risk aversion relatively a stronger factor to deal with from an emerging market perspective than anything else. And to that extent, we might continue to see lower FPI flows into the domestic debt segment. Equities, I think, again, you have given the upsurge that we had seen during the COVID period in terms of the SIPs. A lot of it has still not been unwound and still continues. So it is a good thing that the DIIs are able to support the market at this point in time and prevent a weaker crackdown in the domestic equity markets.
Right, and also from the perspective of short-term financing rates right now, commercial papers or even shorter tenures, do you foresee any sort of moderation in that part of the market?
Well, I think, but to a certain extent, I think the strategy of the RBI is clear. Whatever level they pause, they'll have to pause. But on the other side, they'll also have to keep liquidity relatively on the tighter side, so that it gives the clear signal that they are interested in containing inflation. So, from a short-term perspective, I don't think there is much benefit that we get if I'm talking of this sort of an atmosphere in terms of reduction in the rates and therefore the short-term rates will possibly continue to remain on the higher side. Now, if I
Okay.
talk from a government securities market perspective, I am possibly expecting a steepness coming through 10-year rising from here on, simply because we are waiting for the fresh supplies to hit us in April, and that is possibly the point in time, given the strong credit demand that continues, we might actually see the 10-year yield increasing, and that will probably provide some amount of necessary steepness to the yield curve.
Okay, that's interesting. But when I hear that, I actually then start thinking, will that actually make a sort of borrowing in the debt market slightly costlier for the corporates?
There has not been too much issuance in terms of the corporate bond markets yet, and that will depend on whether there is a cycle that emerges whereby corporates become more interested and intended in term money, which is money for a longer term for capacity expansion. That still does not seem to be on the horizon. But only if that emerges, we should see corporate yields rising. Otherwise, I think the spread between the government securities market and the corporate bond market continues to remain in the current tight zone. I don't think there is any significant upsurge that we can see even in terms of the spreads.
Okay, sir. Let's move towards your GDP forecast so far, which you're maintaining. Please help us with those forecasts.
So for the current year, we have for now taken into consideration the CSO's estimate of 7%. And given all the story that we talked about, interest rate increases, inflation remaining sticky, therefore some amount of domestic slowdown playing out, and that's the only way that you can manage prices. We are expecting growth to be at around 6% for the next 6.2% for the next financial year. We will possibly have a bit of a downside to that, given that at this point in time, agricultural growth for us is about 3.5%, which is broadly the CAGR of the last 5 years. And if there are certain sort of reductions over there, we can see a direct hit in terms of the growth. There can be some indirect hits through lower agricultural produce, therefore relatively stickier agricultural prices, more sort of rate hikes by the Reserve Bank of India, and that to a certain extent emerging as a constraint on private consumption expenditure. So right now we are maintaining a 6.2 with a slight downward bias.
Right, sir. And if I want to sum up your views from a neutral perspective, will I say that right now you're slightly cautious on the economy, or it's almost neutral, or more positive? Like, how should I put your bias?
Once again, you have asked me a very difficult question. I think as an economist, we should not have any biases. We should look at the data like the RBI.
I should frame my question. What's the data telling you?
The data is telling me that we need to be cautious. Let's not sort of jump about and think that there is no problem in the Indian economy. Yes, growth remains. We are one of the fastest growing economies in the world. But let us not forget that whatever is happening in the rest of the world can have a rub down reaction on India. And more importantly, rather than the growth, I am more bothered about how liquidity flows pan out, more like how global liquidity comes into the Indian economy, because that will have a lot of implications in terms of the future productive capacity of the economy. So I think that's the story for the Indian economy at this point in time. Appears to be resilient with some downward risks. I don't think there are significant upward risks to the economy from a growth perspective immediately.
Okay, and my last question to you as we wrap up the show, and that would be, what would be the next important economic trigger event you are looking for the Indian economy? Any next data point, major data point, or what are you actually looking as next sort of point of data?
I think for me, it continues to be the next RBI meeting. And beyond that, it is inflation, inflation, and inflation. Because that, to a certain extent, remains one of the most crucial concerns of the world as well as India. And given that we are a targeting central bank, we can't allow inflation to rule on the higher side, which necessarily means if inflation does not tend to come down, uh, the, uh, the, the RBI might actually be tied to raise interest rates further into an even more restrictive zone, and that can hurt the economy in a more severe way. So I think my critical interesting point at this point in time is how global inflation and also domestic inflation pans out, hoping that there is no further negative news on the financial crisis issue and we don't have a Lehman moment.
Okay, so those actually are the insights coming from our renowned expert, Mr. Indranil Pan. Thank you, sir, for coming on the show. And we
Thank you very
wrap up
much.
the show with two and three important learnings. Number one, remain cautious on the economy. Number two, inflation remains a watchful factor as it is continuing to actually be tracked. And number three, some imminent slowdown in the consumption growth is perhaps on the anvil. And with those thoughts, we wrap up the show. Dear viewers, hope you enjoyed it.
Subscribe to our YouTube channel for in depth interviews of India Inc. and press the bell icon so that you do not miss our updates.